all these budgets together are called the master budget. Now, the master budget is two parts. There's the operating, that is the sales and the production and the marketing and those types of budgets. These are individual budgets that are prepared. They're basically building an income statement. At the top, the sales, then the cost of goods sold, then general and admin expenses, and so on. Aside from that, there are what are called capital budgets. Capital budgets are long-term budgets. Now, that's not the subject of this chapter. That's the subject of part of your finance course. But there's a cash budget. That's very much the subject of this chapter. And we'll talk more about the cash budget later. That's one of the most important budgets. So here you have the master budget components. You start off with the sales budget. They tell you what they think they're going to sell for the year. Then the production manager produces enough to meet the sales budget. Then the production manager also determines, or the purchasing manager then must get enough material to meet the production budget. The production manager must make sure he has enough direct labor, and then they do the manufacturing overhead budget. Those are the different areas in the manufacturing plan. Then there's the selling and admin budget and expense budget. And when you take all that together, what you have is a budgeted income statement. Now, the financial budgets are down here. The capital budget is long-term, that's 5 years. We're not interested in this chapter on that. What we are interested in is the cash budget. We must make sure we have enough cash to pay the bills throughout the year as those bills come due. So the whole thing starts with the sales budget. This is the first. They give us the best estimate of sales revenue. And they break it down, expected unit sales for each product and the selling price for each. So this budget is rather straightforward. Here we have quarter 1, 2, 3, 4. Expected units of sales, 3,000, 3,500, 4,000, 4,500. Unit selling price, the selling price per unit is going to remain the same all year long at $60. So therefore, sales the first quarter, 180,000, second quarter, 210, third quarter, 240, 270. Okay, now from there, the production budget. Now the production manager has to produce to meet the anticipated sales. But there's something in addition here. Not only does the production manager have to produce to meet the anticipated sales each quarter, but there will be a policy that management has put in place. And that management would say that they want ending finished goods to be a certain percentage of next quarter's sales. So now the manager must, to determine how much he produces each quarter, he looks at how much will be sold during the quarter, plus how much does he have to end up at the end of this quarter in ending finished goods. But he starts off the quarter with beginning finished goods. So it's budgeted sales plus desired ending inventory minus beginning finished goods. And that gives him the determination of what he has to produce. Now, an example. Here we have Hayes Company. Management believes it can meet future sales within an ending inventory. They want ending inventory 20% of next quarter sales. So here's the sales. 3,000 first quarter, 3,500 second quarter. Now, I need to end up the first quarter with 20% of what I need for sales in the second quarter. So 20% of 3,500 is 700. So I need 3,700. But because it's management's policy that was consistent last year, at the end of last year here, we ended up with 20%. We had to end up with 20% of what we needed for the first quarter, and that would be 600. So therefore, sales plus ending inventory minus beginning inventory, I need to produce 3,100 in the first quarter. Now in the second quarter, there's my sales, what I'm going to need, and I must end up with 20% of next quarter's. So 20% of 4,000 is 800. So in total, I need 4,300. But I already have the ending inventory last quarter is the beginning inventory this quarter. And so therefore, I only have to produce 3,600. And you follow that all the way through. Now, here you need to know what the sales are going to be the first quarter of the next year. And they tell you, expected sales first quarter next year is 5,000 units. So 20% of 5,000 is 1,000. That's how they get the 1,000. So that's the production budget. The direct material budget is very similar. Now we have to determine how much we have to purchase to meet the production budget. This shows we have to figure out first the quantity, and then we multiply it by the cost. Again, management has a policy that with regards to raw material or direct material budget, you must have the desired ending inventory. In this case, it would be stipulated as 20%. So you do the same thing again. Direct materials used required for production plus desired ending inventory at the end of each quarter minus the beginning inventory at the beginning of this quarter gives us what we have to purchase. An example will give you a better idea. Management says you need 10% of next quarter's production, and the manufacturing of each unit requires 2 pounds of raw material at $4 per pound. Now, word of advice, don't deal with the dollars until you figure out exactly how much you need in pounds first. Deal in pounds, and on the last line, just multiply it by $4 per pound. Let's go. Here we have units to be produced. Now, this came from the production budget, the one we did before. Remember, we needed 3,100. Okay, that's what the production manager says he's going to produce in quarter one. We need 2 pounds per unit. Therefore, we need 6,200. Now, the second quarter, the production manager said he was going to do 3,600. We need 2 pounds, so we need 72. So go back to the first quarter. So this is what we need to meet production. Plus, we need 10% of next month's requirements. So in total, we need 6,920. But we already have 10% last year of what our estimated requirements would be this year. So we subtract the 620, and the total amount we need to purchase in the first quarter is 6,300 units. Then you multiply by the dollars, and you get 25,200. Again, second quarter, we're going to need 7,200 purchase, but we have. Now, that's what we need for production. We also need 10% of third quarter. There's our total needs, but we already have 720. So therefore, we need 7,300, and it costs $4 per unit. So that's how we build the direct material budget. The direct labor budget is straightforward. All we have to do is figure out the production manager tells us the units to be produced. We figure out we're told the time to produce one unit and the cost, and we get the total labor cost. So the production manager is going to produce 3,100 in the first quarter. It's going to take 2 hours to produce each one, so it's going to take 6,200 hours, and the cost is $10 per hour. So the total cost for direct labor is $62,000, and so on. We just use the production budget. We don't inventory labor, so we don't have to worry about it. The overhead budgets, now we have to deal with fixed and variable costs. Now the fixed are going to remain the same within a certain relevant range. We have to look at the variable costs per direct labor hour. And so we get those variable costs, and then we go back and we said, okay, the direct labor hours, we're 6,200 in the first quarter. Indirect material is $1 per direct labor hour, so it's 6,200. Indirect labor is $1.40 per direct labor hour, and this direct labor hour, of course, comes from the direct labor budget. And in this way, we build the variable costs, and the fixed costs are going to remain fixed over that range of activity each quarter. And in that way, we have built the manufacturing budget. The selling and mint budgets, they're basically done sales commission freight out. They estimate the amount of sales and the amount of advertising, sales salaries, and so on. We come up with a budgeted income statement. And you get into further details on that, but we just take the sales budget, which we developed, the cost of goods sold budget, gross profit, and so on. So if we meet all our budgets, we will expect to make a net profit of $47,900. So that's how we build the operating budgets. Now, the very important budget is the cash budget. And here we look at the expected or anticipated cash flows. All right. We look at the cash coming in, which we say cash receipts, and the cash going out, which we refer to as cash disbursements. And we show beginning and ending cash balances. So basic format for a cash budget is beginning cash budget, add to it the cash receipts, and we're going to itemize them, and deduct from them the cash disbursements, which we will also itemize. And we look at the excess of cash receipts over cash disbursements. And we determine if we need financing, because we need to have the cash, and therefore there would be management's policy with regards to what minimum cash balance would have to be. The cash receipts section includes principal sources of revenue, that is cash sales and collection of credit sales. The disbursement includes all cash payments, direct materials, labor, taxes, dividends, whatever. Basically your expenses, but not depreciation, because depreciation is a non-cash expense. And then the financing section looks at how much I have to borrow